So we will be recording the webinar, and we're going to be emailing the recording to all of the participants, so no worries on that one. A couple of notes for you social media lights out there. We have some handles and hashtags that you can be using in your tweets and otherwise, so please feel free to get that out there. Everybody is going to be muted as you join. So if you have any questions, if there's anything you'd like to say or ask one of the panelists, please use the chat function. And if you need any help with Zoom, which is what we're using for this webinar, then please feel free to shoot an email to marketing@datamaran.com, and one of my colleagues will try to help you there. So next slide, please. My name is Ian van der Vlucht. I am the Director of Product at Datamaran. Next slide, and I will be your tour guide through this content today. And we're talking about the TCFD, and so my job is basically to frame this a bit so we can get into the really meaty heart of the discussion with the panelists. So there are a couple of key characteristics that I'd like to just point out related to the TCFD, the Task Force on Climate-Related Financial Disclosures. The first is it was sort of born out of a fundamental risk to business. So in 2015, the Financial Stability Board said there is a potential major crisis waiting to happen related to the global economy, and the cause is climate change. We are not addressing this in a manner fit for the scale of the risk, and there's more that we need to do. So the task force was set up. It's not an altruistic sort of do good because it's the right thing to do approach. It's an industry-led, business-oriented framing of a major problem to the global economy that focuses on disclosure around climate-related risks and opportunities, and specifically provides recommendations for how companies can integrate that into their financial filings. As such, it also works to build a bridge between the capital markets, which are sort of the consumers of this information, if you will, and the ones that fundamentally need to ensure that that our global economy is not going to drop off the side of a cliff, and the business sort of corporate side of things, who are the ones who need to be better prepared for also managing these risks to their business. Next slide, please. So the TCFD recommendations were published in 2017. It was sort of couched in governance with some key focus areas. We did a bit of a scan through our data at Datamaran, and published a report earlier this year that coincided with the second update report also published by the TCFD. I wouldn't say our findings were very different from what the TCFD also discovered, but there are a couple of interesting points to note. One, yes, we definitely see in financial reports a growth in mentions of climate change and the way in which those are being, the manner in which they're being discussed. But some caveats, the financial impacts of those are not being reported very well, if they're even being assessed at all. Risk is still viewed predominantly on a long-term time horizon. So short-term risk is not being discussed nearly as much as long-term risk, leading us to believe that we're still sort of pushing this monumental task out to a distant unknown future. Companies are also talking a lot more about the downside risk than the opportunities presented by climate change and the transition that this is going to cause. And then, some of the more technical details promoted by the TCFD, for instance, scenario analysis, in order to build resilience into corporate strategies, is largely absent from disclosure. So it was sort of recognizing this, having a discussion during Climate Week with our CEO, Mariela Alma, and she said, we know what the North Star is, right? The TCFD is sort of what everybody needs to be doing. everybody seems bought into this idea. During Climate Week, there was lots of discussion about TCFD and what this meant, and everybody sort of on different trajectories to trying to crack this nut. But why are we not seeing more momentum? What's stopping companies from sort of just getting on with this and driving this forward? Because we know it's a huge problem. So next slide, please. And that was sort of the genesis of this webinar, if you will. What we wanted to do was assemble this group of expert panelists to talk about the journey of sort of implementing the TCFD recommendations, just getting started, and what that takes. So what are some of the challenges? What are some of the solutions that we've seen within the Datamarans community already? Why is this information so important to the investment community? What are some of the implications if corporates aren't picking up the mantle, so to speak? And just a couple of months ago, we had a presentation by Mark Carney, the governor of the Bank of England, and then also the convener of the TCFD, who said companies basically have 2 years in order to get this right, and if they don't, then it's going to be forced upon them. So that was sort of the onerous regulation, red tape coming down the line there. We wanted to talk about how the TCFD presents an opportunity to break down some of the internal silos that lots of companies have, bring out some of the ingredients for conducting a meaningful scenario analysis, and how you can integrate that best into your corporate strategy. And then finally, so how can you move forward on this journey and embed some of the TCFD recommendations into your business operations. And so to get us started on this discussion, next slide, please, is Francisco Jose Alvaro Tomas, who's the Director of Reputational, Environmental, and Social Risk in the Responsible Business Division of BBVA. And Francisco is going to be giving us the corporate perspective from a company that's just now gone through this sort of first iteration of implementing the TCFD recommendations. They are a signatory to the TCFD. They're bought in from the beginning and sharing some of the challenges and then solutions that they came up with as they progressed through this. So Francisco, are you with us?
Yes.
Fantastic.
Can you hear me? I'm not so sure.
Loud and clear. So it's over to you.
Perfect, because I've had several technical problems. So I think we can start. So first of all, thank you very much for your kind invitation. And I think it's very important for all of us, for all actors, to share information about this road. I mean, we are all in a road to. We say now in the bank, all roads lead to Paris. It's a sentence that we have shared with our colleagues of other departments. And the TCFD recommendations are a very important element of this. I don't know if we can start with my presentations. Okay, I wanted to show a, let's say, operational or practical approach how BBVA has been approaching the TCFD recommendation. But I would like to frame a little bit the sensations that we had in the beginning, and what is the framework of the whole thing, of the recommendations for a company, for a bank like BBVA. Well, first of all, we are talking about reporting disclosure recommendations. So Well, the first approach to our colleagues within the bank, well, we all have very, very old disclosure dynamics. Everybody has to cope with regulations, especially in the financial sector, well, it's really not easy to change these dynamics and to change these very mature processes within a bank. So it seems to be a very difficult task. Maybe it's not impossible. It's not mission impossible, but it is indeed a very difficult task within the bank, moving all the departments, moving all your colleagues into the same direction. Well, the second element of the framework for me, I'm not sorry, just come back to, is that companies are under a lot of pressure to be more transparent and to be open to many stakeholders, and not only to stakeholders, because the society as a whole is reacting to the topic climate change. Climate is not more, maybe it's not even more climate change, but climate crisis in some circles. So it's a very hot topic, and it's a social one, and banks are main actors in the society. So we are under pressure, under a very big pressure. A third question, and this is my personal experience, and from conversations with other colleagues from other banks, we all agree, although in silence, but we all agree that it's a very sensible reputational exercise. So banks are not always used to be very, very transparent or extremely transparent, or we disclose things that are not very comprehensible for many people. So in this case, talking about risks and strategy, there's much reputation at stake. And the last thing is that this is all very uncertain. The whole thing, the climate change, the climate change effects, risks, opportunities, everything is very uncertain. So uncertainty for a bank means problems, because we don't like uncertainty. We like to be more or less sure that things are going on like we would like to be. We would like these things to be. So if you go to the next slide, please. So well, when we started with this, I don't know how much time do I have, and if you have to cut me, Ian, please do it or send me a signal. Okay, TCFD recommendations are these recommendations, and they are not regulation. So banks are used to react to regulation, not to recommendations. But BBVA did react to recommendation. To the TCFD recommendations. It's not always so. It's like a voluntarily exercise, but it's not regulation. Regulation is coming, especially in the European Union. It's not only the taxonomy, but well, the EBA is going to act in a short time. Is going to strengthen the reporting processes, the ESG risk reporting processes, and maybe next year we will see not recommendation but regulation to disclosure ESG aspects, maybe within Pillar 3 and in the future in Pillar 3 for banks. I don't know if there are many people that know about this concept, but it's going to be regulated. So not now, but it's going to be very regulated. BBVA decided to publish a specific report to comply with TCFD recommendation, and we will go even further. But it's true that in the future, our strategy is to include the TCFD report or integrated with the rest of the public reporting of BBVA. We want to make TCFD recommendations business as usual. So we don't see TCFD recommendations as something special, a special report, something that you have to report apart. It's going to be integrated within BBVA, BBVA's business as usual. Next, please. I have decided to speak about several opportunities and challenges that we have found within the four pillars of the TCFD recommendations. So I don't want to bore the whole audience, or I don't want to be very boring, but it is more what we have found and what we have seen as opportunities and challenges. Maybe we have time afterwards to discuss.
So Francisco, we have about 2 minutes. So are there like any key challenges? What was the biggest hurdle that you faced, and then you know, what did you do to overcome it? And then we can circle back.
Well, everybody's going to find a big problem with data. So the pillars, in my opinion, for TCFD recommendations are metrics and risk management. So for both things, the most challenging question is going to be data. And afterwards, the second main point for me is the lack of standardization of everything. So, for example, scenarios. We don't know. We have been in talks, for example, with the regulators, and they say, well, we don't know. Well, if you don't know, it's very difficult to build scenarios and to know what to do. So I would say TCFD recommendations now, the most challenging things are data, and then scenarios in order to build a good strategy. So this is the key points that we have found during this part of the way.
Excellent. Thank you very much, Francisco. And we're going to get back to some of the other content that you had. But first, Saskia, if you wouldn't mind jumping forward to Martina's section, we are going to hear from Martina McPherson, who is the Senior Vice President of Strategic Partnerships and Engagement at Moody's Investors Service. So Martina is going to give us a bit of the capital market perspective. What are we, why is this information so important to investors? What are they doing with it? And what's sort of the push and pull here? So Martina, thank you very much, and it's over to you.
Thank you very much. Saskia, would you mind moving to the next slide? Thank you. Hi, everybody. It's a great pleasure to be on Datamaran's webinar again, and to speak today to a very important topic, TCFD disclosures, governance disclosures and reporting, I should say. And for investors to frame the discussion, this is a very important debate, because there is confusion around alignment, there is confusion around momentum, there is confusion around discrepancies of information, as we had also heard from the previous speaker. And there is clearly, though, a momentum that is driving, and that's literally taking off across the stakeholder value chain, the momentum of sustainable finance and ESG. And we are literally looking at policies, makers and regulators. We are looking at investors. We are looking at corporations and the intermediaries. And we're hearing, of course, from ERM and the consultant space right after this session here. So the momentum that we are seeing from an investor's perspective is that momentum of social and environmental and governance strategies, investment strategies that have actually now raised around $30.7 trillion US, and that have created commitments from signatories in various areas. First of all, and up and foremost, the principles to responsible investment. We are seeing soon up to $80 trillion US committed via a broad range of signatories in the investors, managers, and intermediary space. We have seen most recently the commitments from banks, hence the context here from BBVA, $47 trillion US. It's a third of the entire banking sector ultimately in volumes committed towards responsible banking at a strategic, operational and tactical level. And we have seen also momentum in the green finance space when you look at the green bond issuances, which are estimated to literally break through the $200 billion US mark for the first time by the end of this year. And that's a phenomenon, literally development in the context of investment strategies across asset classes that have risen now to the forefront across investing and capital markets. What we're also seeing is that investment managers have become increasingly engaged in the topics. I don't know if you've followed some of the studies. For instance, here Morgan Stanley's Investment Institute is putting out a regular information stream on how ESG strategies are being looked at from an interest perspective as well as from an adoption perspective, and not just only in the context of what is very often quoted, the value investors, the millennials, but also more generally the sentiment and behaviors of investors across the spectrum. And I really think the most recent study they brought out, where they've shown across the spectrum 800 investors with a $100,000 US investable assets baseline or base case scenario, looking at how these investors have now literally across the spectrum from E themes, climate, into S themes, for instance, diversity, inclusion, have looked into increasingly investing in accordance with their value expectations, and how they are looking into developments around products in this sphere has actually brought up to light an interesting development. And that's actually this current disconnect that we're having a huge demand, but not a lack of supply when it comes to product, or lack of supply, apologies, when it comes to products. And we are having a lack of alignment when it comes to the relevant type of frameworks and standards. Ultimately, the call here for also the rating agencies in this space to become standard setters when we took and look at ESG disclosure, taxonomies and reporting, in line clearly with the last but not least development, the major policy developments. You see the policy perspectives here on the right-hand side. We have seen literally a mandate that has moved from voluntary to mandatory, from normative to regulatory disclosure and reporting in the broader context of governance measures. And you have seen initially a lot of initiatives, industry for industry, TCFD up and foremost, and you have seen materiality frameworks being built, launched and issued by the Global Reporting Initiative, by SASB, in line with the capitals outlined by the IRRC. So there's now there are multiple layers of standards here, normative frameworks that have been utilized so far. And this development has now led to an interesting, more regulatory development at the EU level with the Sustainable Finance Action Plan. As you will probably know, most recent stakeholder consultation in June brought to light the four main pillars that the EU Sustainable Action Plan is focusing on. Up and foremost, that is the taxonomy in the moment around environmental factors, ultimately disclosures. Secondly, around climate-aligned benchmarks, 1.5 and 2 degrees, and ESG disclosures on all benchmarks. Then ultimately, the enhancement of the EU Directive 2014-95, the disclosure of non-financial information and diversity. And last but not least, the Green Bond Standard. Again, an alignment between a principles-based approach as set out by the Green Bond Principles and a taxonomy rules-based approach as, for instance, set out by the CBI and many other type of multipliers. And these developments combined investors' perspectives, policy perspectives, and ultimately the corporate alignment and demands for further disclosures and alignments around data and reporting has led now to this interesting development that we're seeing with the TCFD framework. If I might lead back to the next slide. And that is actually this alignment around the strategic pillars that you have all probably discussed and seen. First of all, around governance, around strategy, around risk management, around metrics and targets, and ultimately around the effectiveness of disclosures in this context. So ultimately, from the initial stages of the TCFD reporting discussion back in 2017, when the pillars were launched to provide further insights and align the thinking around climate risk-related disclosures, physical and transition, we have now seen that there is an enormous drive to more effectiveness of disclosures, and the idea of organizations, industry for industry, policymakers and other multiplier groups such as UNEP-FI, the PRI, and increasingly the regulators here, the pensions regulator with its own task force, that are now looking into increasing effectiveness of disclosures when it comes to company reporting. I give you an example where the reporting discussion is at the moment. We are looking in 2019 at an increasing focus on the type of disclosures and the trajectory of change that we are seeing within reporting. Initially, when the TCFD framework was launched, there was more focus around building an alignment around frameworks, type of KPIs and metrics for disclosure. And now we are aiming to, obviously, or the organizations around the TCFDs are aiming to see a broader alignment when it comes to the type of disclosures and the type of metrics that are being utilized, because there seems to be, from the latest TCFD 2019 report, a disconnect between what companies are seeing and displaying and disclosing as material and how they're ultimately reporting on the trajectory of change in the context of climate risk. And last but not least, just to quickly confirm what that ultimately means in the broader context of ESG and TCFD disclosures, it means we are seeing a trajectory of change and the indicators are out there. We are seeing a change and a move within companies from where and how information is collected, monitored and reported, from the CSR teams to the corporate strategy, risk management, and ultimately from a very top-down strategic level, a perspective on an alignment with frameworks, especially around TCFD. Here at Moody's as well, we have also kickstarted our own TCFD reporting efforts in that context, very much in the finance team. Then we see, from reputational to litigation risks, a trajectory of change when it comes to understanding of the type of risks that are related to different ESG mechanisms. We are seeing ultimately a change from voluntary, as I outlined, to mandatory disclosures, from normative to regulatory developments. Again, as I'd outlined, we are now looking in the context of the TCFD framework, for instance, for the first time at the implications, even at a UK pensions regulators level. And ultimately, the mandatory reporting element is key here as well when you look at PRI and the mandate for making signatory reporting in the context of TCFD mandatory as of 2020. We are looking at the move from investor coalitions up to public policy, and we are looking at ultimately the developments around principles-based to rules-based approaches and taxonomies. And TCFD is interesting and a very good example here in and when and how these sort of changes and trajectory of changes are ultimately happening and are becoming aligned.
Martina, thank you very much. I think some of the topics that you've brought up and taking some notes, they resound quite well with some of what Francisca was saying, and I think also what we're going to be hearing from Charles Gooderham, who is a partner at ERM. Thank you very much, Saskia. And he's going to be providing us with sort of the advisory consultancy viewpoint, really boots on the ground, helping companies go through this process. Charles, what's that looking like? You know, can you give us a bit more flavor around you know, what Martina was mentioning, moving things to finance out of CSR, breaking down some of these silos, and then maybe a bit on the technical know-how that ERM is able to bring to the table here. Over to you.
Oh, thank you, Ian, and good morning, good afternoon, everyone. Thanks for the invite, Ian, to join today. Many of you will know ERM as one of the world's largest independent environmental social consulting businesses. We've been advising clients for a very long time on climate risk and opportunity, which is why the TCFD invited us to help draft some of the technical guidance around scenario analysis. I lead a lot of our engagements with financial service clients, banks, asset managers, sovereign wealth funds, and increasingly, interestingly, some of the private side of the market, private equity infrastructure funds are also beginning to look quite hard at this as they get pressure from their limited partners. So I'm going to share some insights and perspectives from that. I think a lot of this is directly correlates to similar experiences we have as a business advising our non-financial corporate clients in this space as well. So Saskia, if we can move on to the first slide, please. Thanks. I'm going to talk about three themes. One is around building engagement and capacity. Secondly, around planning for effective implementation. And then, of course, to talk about scenario analysis, which is at the heart of the TCFD recommendations. On the building engagement and capacity piece, this, as the other speakers have said, is a complex beast to tackle, and therefore needs some careful internal stakeholder management and engagement building to get this to work. And what we've seen often as a first good step is to get some common sense of understanding around the science, the policy, and indeed your organization's stakeholders' expectations, whether that's your investors, your regulators, your other stakeholders, and really have a common position on that. We find too often, people bring their own personal perspectives to this, and let's be honest, this can be a very personal thing to many people. But as an organization, you need to have a common position on this to really move this forward and engage with people. I think secondly, people often initially come to this with a very much, this is just another ESG reporting initiative. And I think moving very quickly beyond that is important so that people begin to talk about risk management, and not just about the obvious risk management. I mean, clearly people's minds begin to focus on, the carbon intensive industries, for example, and that there are many examples where, it's companies that are in the value chain of a high carbon industry, but not necessarily a high carbon, high greenhouse gas emitter that can clearly be at risk. You look at some of the big turbine manufacturers and some of the layoffs they've had for staff recently because they're just not selling in the market because there's not demand for large thermal turbine units, with the demise of large thermal coal power stations, etc. And then I think ultimately moving the conversation on to, where the real interest here is the opportunity, the very quick, very significant and very diverse changes that we're going to see in our markets and in technology, and the opportunities to invest in those and be part of that transition to a low carbon economy and to build out resilience in your assets is key to really grabbing people's attentions. I think next is around managing expectations. There are no 5-minute fixes here. TCFD set out a 5-year program to align with its recommendations. And yes, whilst we're a couple of years into that, again, I think people need to understand that, to deal with this complexity, will take time, and it's important to kind of build a plan which everyone is bought into to implement. And you can go through a sequential set of actions year on year. You're able to communicate those to your stakeholders in terms of your intent and then your execution of those. Everyone can feel comfortable that as an organization, you're moving forward on this. And then lastly on this slide, really the back to the complexity point, I think, you know, for a lot of organizations, this is one of those examples that needs a lot of different functions and different levels of the organization to come together, from, you know, board to exco, right through the management tiers, and we see a lot of clients creating quite large programs around this, so having a program office that can really manage and pull this together. Who are the guys that you need on the analytics side, and who ultimately in the business is going to think about the strategic response to this and embed, from a tactical point of view, risk management into all your processes, etc., around climate. If we can move on, Saskia, onto the next one, which is around sort of planning for effective implementation. And again, sort of, I guess, reiterating the point I made earlier, you know, to tackle the complexity of this, having a plan across what are often big, complex organizations, you know, financial service sector, you've got very large portfolios you're dealing with, different asset types, different sectors, different geographies, etc. And for a non-financial corporate, equally, you're operating you know, many assets across different jurisdictions. You've got different supply chains and obviously different customer groups and products and services. So, you know, having that clear plan set out and stepping through a process to design that and make it workable is important. So again, understanding who your key stakeholders are in the business, engaging them, undertaking some sort of materiality assessment, which is combining an understanding of climate-driven risk and opportunity together with your financial exposures as a business, and putting those two together so that you really understand where your concentrations of risk and opportunity are, then allows you to kind of do some gap analysis against, you know, the processes you already have in the business, what might already be talking to the recommendations of the TCFD, or could be built on to meet those recommendations. We find lots of clients are clearly very interested in what their peers are doing, so often we're doing peer benchmarking on the disclosure and arrangements to kind of see who's you know, mature in this space. You know, some of our clients, you know, they've set themselves targets to be, you know, top globally or top in their region or in their sector in terms of the quality of their disclosures. And I mean, the implementation plan's interesting, particularly from a UK perspective, because we've seen the Prudential Regulatory Authority that regulates banks and insurers in the UK put out their initial supervisory expectations this year, which has required those organisations to formally submit an implementation plan. So you see there the seeds of mandating and regulating TCFD, which for most is you know, is voluntary at the moment, with expectations that certainly over coming years that regulation will be more crystallised and spread further. If we can then move on to the next one, then thank you, Saskia. So let's talk about scenarios here, and let's just make sure that we, you know, many of you may be familiar with the use of scenarios, not necessarily for climate. They're widely used in business practice anyway, but they are absolutely not forecasts, and they are not in themselves stress tests or any type of sensitivity analysis, albeit that they could be an input into a stress test. And clearly for climate, they are important as a tool of looking forward over the long, medium, short, medium and long term. And that's very much what TCFD calls for, and that they are calling for the use of this in thinking about strategic response for your businesses in the different pathways. And all this diagram seeks to illustrate is a range of different pathways that we could go on or are going on. The red line is our pathway at the moment, which will take us to a 4-degree world. The blue line takes us to a 1.5 Paris target. The lighter blue line is the combination of the current nationally determined contributions under Paris, which will take us something to the order of a 2.73 degree world at the moment. And the yellow line is the least cost pathway. So effectively what we have here is a risk and opportunity envelope, and you know, it's where you want to put your bets within that envelope for you as a business as to how you think policy, technology, markets, etc., will play out in the pathway to take us to a decarbonised economy. And of course, if those policy responses and technology responses don't happen, we are on our four-degree pathway, and we need to be managing the physical side of impacts anyway. So there's no get out here. You know, there are things to be managed whichever way you look at it, whether it's physical or transition, risk and opportunity. We can just skip on to the next slide then. Thank you. So in terms of trying to kind of step into the scenario analysis, what we tend to take clients through is often a three-tier process. One where we're kind of doing heat mapping exercises, often at kind of sector level, or if it's a corporate, non-financial corporate client, at kind of asset type level, and really trying to think about you know, employing different scenarios and indicators to give some sense as to where risk and opportunity hotspots are across the business as a whole. And really that then helps filter out, and it is only a filter at this stage, where you then want to you know, invest further resource and further investigation into risk and opportunity. You're then into the kind of second and tertiary levels of analysis, where you might want to unpick a particular sector that might be geographically defined, for example, and you might be, say, looking at oil and gas. You split it into 7 different segments, you know, up, mid, downstream, on, offshore. You might look at particular exposures to things like oil sands, for example, or deep sea, and really then thinking about what are the linkages between climate drivers and financial outcomes, i.e. outcomes in terms of revenue erosion or increase, or in terms of impact to CapEx or OpEx. So beginning to create that mindset or mind model around that mapping, it is very helpful in terms of moving the business forward in its thinking around these linkages. You haven't necessarily at that stage got to a point where you're quantifying this, and that's the kind of third step where you then begin to think about, well, what are, if I get this quantum of change, what is the financial impact? And some of that can be very simple, because if one of your key drivers is a carbon price in a regulated carbon market, you know, that price goes straight to OpEx, and you can clearly understand the impact on the financials for the business there. Other things are more difficult and have a high degree of uncertainty. So if you're thinking, for example, about the transition to electric. Hi.
I'm just gonna stop you there, just so that we have a bit of time to allow the others to sort of chime back in and reflect on some of the topics that
Sure.
That we've addressed, if that's all right.
Of course, yeah, no, I think I'm well done there anyway.
So thank you very much to the 3 panelists for helping to set the scene here. If you have any questions from the participants, please type them. There's a little Q&A box down in the bottom. If you just type your questions right in there, then they'll pop through, and we'll save a bit of time at the end to address those. But I wanted to circle back to Francisco. You know, we've heard sort of the investor angle, looking at increasingly at the effectiveness of disclosure. We've heard from Charles about.
Sorry.
That's all right. The building engagement and capacity element. So I think I'd like you to sort of dig into that one a bit more, around the governance that had to be set up for this TCFD approach. You know, what did you have to do to get internal buy-in from all these different departments and different internal stakeholders, and you know, what was the biggest selling point for you that made this effective?
Well, can you hear me? Yeah.
Yes.
Okay. Well, tone from the top is very important. We are at BBVA very lucky that both the board and the global leadership team they have understood and they have bought the necessity of advancing, of getting on with this. It's not only a question of complying with the recommendation, but it's a question of the banks and the sector reputation and sustainable business. It's a question of how the bank will be in the future. What kind of bank do we want to be in the future? Maybe we won't see it, some of us, but it's a question of sustainability of sustainable business. So this is a very old bank from 1870 more or less. So it's a very old bank, and it should be also a bank in the future. It should be a sustainable business. So it's a question of long-term view. So you have to get the board and get the managers on board. And then, in our opinion, you have to adapt your current structures and your risk management framework and your committees, your current business lines. I don't think we have to reinvent the wheel. It's a question of adapting, integrating these new drivers, integrating these new views, and getting it right and ongoing. So I think you don't have to do anything very new, but to get the support, especially from the board and top down. This is very, very important. If not, it's very difficult from a function like, for example, responsible business. In our case, it's very difficult to move an organization so big like BBVA. It has to be tone from the top, especially.
Excellent. Thank you very much, Francisco. So I'm going to be kind of taking and integrating some questions that are coming in together with a few of my own. So we have one from Simon about good examples of corporate TCFD reporting. So Martina, as the investment community is looking more at the effectiveness of disclosure away from just, is there a governance model? Is this being implemented? What do you think is currently missing from the disclosure paradigm, and what you're seeing being reported by companies? And then, I guess in response to Simon's question, what are some of the best practices that you might have seen thus far?
Very good question. I think I'm referring here to the status report 2019 of the TCFD, which had an analysis, or included an analysis of 1,700 companies. What came out of that analysis, which is quite telling, is that most companies now that have committed to TCFD disclosures disclose some type of climate-related information. But ultimately, what's missing is very often the financial implication and the link back to what the TCFD framework is about, the climate-related risks in the context of financial implication. So ultimately, that's one major challenge. Disclosures are also made very often in various companies' reports. So there's not a single source, so there might be a financial filing, an annual report, a sustainability report. The alignment aspect of reporting is another key issue. What's also been said that larger companies, and particularly European companies, disclose more related to the recommendations. But ultimately, few companies overall implement or literally use the climate-related scenario disclosure processes for ultimately identifying, assessing, and managing climate risk, or integrating it into an overall risk management strategy. And lastly, disclosures vary industry by industry. So ultimately, there's maybe a question around materiality and an alignment with other materiality-linked disclosure and reporting frameworks, such as SASB. So that means ultimately, last but not least, data disclosure reporting requires further alignment. And this is something that the TCFD community, the banking community in that sort of broader context, also with some findings from UNEP-FI, and increasingly investor community has realized. Hence, you know, again, there is the link back to the PRI, who is now making TCFD reporting mandatory amongst its community of signatories as of 2020.
Excellent, thank you, Martina. Now we're getting lots of data-related questions in. So Charles, I'm going to throw this one at you. You know, I think not all of us here are sort of quantitative data experts. The task might be a bit daunting, especially when we look at all these different pathways and line charts and trying to unpack all of this information that needs to play in. So what advice would you give to a company that's just sort of setting out on this, conceptualizing what this means and what data they need to have, and maybe isn't the most skilled with this? How can they just get started on this?
Yeah, thanks, Ian. I think, I mean, go back to my initial point around, you know, setting up a funnel here so that you are stepping in with some fairly high level analysis to start with. And I mean, scenario analysis does not have to be quantitative, it can be qualitative. So again, it's, you know, and this goes to actually something that a lot of our clients comment on, is that a lot of the value they get from our engagements, it is not necessarily the tools and the analytics that we provide to them, but it's just the learning process that they go through as an organization. So I think that is key in itself. Clearly, there are a lot of different data sources for both physical and transition. Some of them are more helpful than others. All of them have limitations. And I mean, one of the key limitations at the moment is, you know, a lot of these scenarios were built for policymakers and kind of national, supranational uses rather than sector and company level. So there is a lot of work and thinking going on at the moment about bridging that gap. And I think for many organizations, I wouldn't get distracted by that initially. It kind of goes back to my point that, you know, you're not all the answers are there. No one's got the answers at the moment. And it's about getting started on this, but beginning to take some small steps into this, and then building up the knowledge and capacity within the organization.
Excellent. And now, Francisco, maybe pivoting back to you with this, the data comment that you made. You know, as you were trying to assemble all this data from across the organization and from external resources, you know, what were the biggest challenges you had with the data? Was it availability or consistency, comparability, quality? What did you have to do to sort of tackle this data challenge on your end?
Well, everything. Okay, the big challenge, in my opinion, is transforming carbon into euros or US dollar. For a company like a bank, but maybe for all the companies, take into account that you are reporting, or in your reportings, you are going to include US dollars or euros. It is what you are reporting. So in terms of trying to get this all these drivers of climate change related risks into your business, you have to be able to transform carbon into euros. So, but the problem is that we have so many clients, and we have so many types of financial products that is very difficult, the approach. So you have to get data for your exposure to the risk. You have to get data for the assessment of the risk, and you have to get data for the follow-up, the monitoring of the risks, and then maybe you can report all this. But you have to get data from many sectors, and sometimes from the economy, sometimes from countries at an aggregated level. So it's very complex. It depends on the client. It depends on the sector. It depends on the product. So we have launched at BBVA a very big project regarding it's called data capabilities. So it's impressive, the work ahead that we have. So the complexity comes from the many different types of relationships that a bank has: asset management business, corporate clients, retail clients, BBVAs acting in 10 countries, a very big footprint in Latin America. For example, data about climate change and Paris Agreement compromises are different from one country to another. So for scenarios, you have to get data also. So it's very, very complex. So we are wasting a lot of time analyzing which type of data for which sector, for which product, and for which process, onboarding process, assessment process, mitigation processes. So it's very complex.
Thank you for that, Francisco. Martina, we have a question on I think what you mentioned, the policy space moving from voluntary to a mandatory sort of disclosure paradigm. What do you see in terms of the near term for stock exchanges and you know, their potential move towards mandatory non-financial disclosure?
This is a very interesting question again. You know, as we all know, the UK Companies Act had already implications here for company reporting and strategic implications around ESG in its frameworks since 2006. In that, in 2013, it added an additional layer of mandatory reporting for carbon disclosures. And the UK government's most recent announcement to actually report on climate, or making climate change risk reporting mandatory by 2020, is driving up the agenda here in the UK, as well as in the context of the EU now with the Sustainable Finance Action Plan and the disclosure directives, driving this really to a pivot where we see voluntary to mandatory reporting and disclosures. In the context of exchanges, it's fair to say that the LSE Group, London Stock Exchange Group, and others in its circle of affiliates and in the broader context of the SSE, the Sustainable Stock Exchange Initiative, have already made some of the ESG listing requirements and disclosure as a key part for that listing requirement mandatory. And ultimately, what is interesting to see is now jurisdiction by jurisdiction, which exchanges are going to follow, and ultimately which type of information they're going to disclose in the years to come. It all started with listed entities, company information. We have seen green finance moving up that same trajectory. Hence, now LSE, Stockholm Stock Exchange, exchanges in Asia have also started to looking into green finance disclosures, second-party opinions, for instance, as reference points in the context of green finance disclosures. So there is an increasing focus on making listing requirements or aligning listing requirements with ESG disclosures and potentially also climate risk related disclosures at scale. And I think that momentum is continue to grow over the next couple of years.
Excellent. Thank you very much, Martina. Unfortunately, we have run out of time. I would love to continue this discussion. I would like to thank our panelists, Francisco Jose Alvaro Tomas from BBVA, Martina McPherson from Moody's Investor Service, Charles Gooderham from ERM, and all of us from the Datamaran community. Thank you for joining today's webinar discussing the TCFD. Just to reiterate, we'll be sharing a recording of this session with all of the participants. If you would like access to the slides, please let us know separately and we can arrange that for you. And from my side of the Atlantic, a very happy Thanksgiving to everybody, and look forward to seeing you next time.